Be honest with yourself for a moment. You work harder than your parents did. You're more educated, more connected, more productive. And yet, it feels like you're standing still. Savings don't grow. Housing moves further out of reach. Single emergency can erase years of effort. Here's the mystery no one explains clearly. How can an economy be strong? Markets hit record highs, and productivity soar, while ordinary effort feels increasingly pointless. Politicians blame inflation. Employers blame competition. Experts blame global forces. But what if the real explanation isn't about you at all? What if the answer sits at the very center of the financial system, quietly shaping outcomes, long before your paycheck ever arrives? Tonight we're uncovering central banking secrets that explain why hard work feels pointless, not through conspiracy, but through cause and effect. Setting the stage, the promise of stability: central banks were not created to make people poor. In fact, their original promise was the opposite: stability, fairness, and protection from chaos. Before central banking, economies were brutal. Bank failures wiped out savings overnight. Panic spread faster than information. Money itself was unstable. So governments created institutions with immense power. Central banks tasked with controlling money supply, interest rates, and credit. They were meant to be boring, invisible, technocratic, and for decades people trusted them. But here's the twist we're building toward. Central banking didn't just stabilize money, it changed what money rewards. And once that happened, hard work slowly lost its leverage. Part 1. Origins. When money was tied to effort. To understand the problem, we need to rewind. In early industrial economies, money creation was limited. Often tied to gold or hard reserves, it expanded slowly. This had consequences. Credit was scarce, interest rates were high, failure was common. But there was one powerful feature. Money growth roughly matched real production. If you worked harder, produced more, saved more, your effort translated into purchasing power. Wealth accumulation was slow, but tangible. Then came the pressure. Wars, crises, political demands. Governments needed flexibility. Gold constraints became inconvenient. And central banks were given a new mandate: manage the economy actively. This was the beginning of modern monetary policy. Part 2. Rise. How central banking learned to smooth pain. After the Great Depression, central banks gained new powers. Their mission expanded: prevent recessions, maintain employment, stabilize markets, encourage growth. Interest rates became tools. Money supply became adjustable. That became policy-driven. At first it worked. Recessions softened. Crashes were contained. Economic cycles seemed manageable. But something subtle changed beneath the surface. By lowering interest rates, central banks made borrowing easier. By supporting markets, they reduced downside risk. By injecting liquidity, they rewarded those closest to new money. This created a divide not between workers and bosses, but between those connected to credit and those dependent on wages. Hard work still mattered, but access to money mattered more. Part 3. The hidden mechanism, WHY effort, lost ground. Here's the secret few explain clearly. Central banks don't distribute money evenly. New money enters the system through banks, financial markets, and asset holders first, not through wages. This means asset prices rise before wages do. Investors benefit before workers feel relief. Inflation hits consumers last. So while central banks aim to stimulate the economy, they unintentionally reshape incentives. Risk-taking beats saving, ownership beats labor, leverage beats patience. Over time, this compounds. People who already own assets see exponential gains. People who rely on income chase rising costs. Hard work doesn't stop paying, it just pays slower than inflation and asset growth. Part 4. Breaking point. When policy reaches its limits, every system reaches a stress point. For central banking, that point came after repeated crises. Each crash required intervention. Each intervention required lower rates. Each recovery relied on more debt. Eventually, interest rates approached zero. At that moment, the traditional tools stopped working, so central banks escalated. Quantitative easing, balance sheet expansion, and permanent market support. These policies were framed as emergency measures. but emergencies became permanent. And here's the breaking point. When money is abundant, but unevenly distributed, effort alone cannot catch up. People work more hours, but compete against money that multiplies itself. Part 5. Fallout: why it feels like running on a treadmill. This is where the emotional reality sets in. People don't feel lazy, they feel cheated. They do everything right. Education, experience, hustle, discipline, yet the finish line keeps moving. Why? Because central banking shifted the economy from earning-based growth to asset-based growth. Wages are tied to productivity. Assets are tied to liquidity. Liquidity has exploded, so effort feels disconnected from outcome. It's not because effort is worthless, but because the system rewards proximity to money creation more than contribution. Part 6. Failed fixes. Why the obvious solutions don't work every few years? New fixes are proposed. Raise minimum wages, tax the rich, regulate corporations, stimulate demand. Each helps temporarily, none address the root mechanism. Because the issue isn't morality, it's structure. As long as central banks manage economies by manipulating credit, asset inflation remains the primary transmission channel. And as long as assets outpace wages, hard work feels like it's losing. The system isn't broken. It's working exactly as designed, just not for effort-based rewards. Modern parallels the pattern repeating today. Look at today's world. Record stock market valuations, historic household debt, housing unaffordable. Despite low rates, younger generations owning less than previous ones. This isn't a failure of ambition. It's the result of a system where time plus assets beat time plus labor. Central banks didn't intend this outcome. But intentions don't stop incentives. 3 clear takeaways. Takeaway 1. Central banking reshaped what the economy rewards, favoring ownership over effort. Takeaway 2. Hard work still matters, but it no longer compounds as fast as money itself. Takeaway 3. When monetary policy inflates assets faster than wages, motivation erodes, not because people are lazy, but because returns feel rigged. Final warning and open-ended thought: every society runs on belief. Belief that effort leads somewhere. Belief that sacrifice pays off. Belief that tomorrow is reachable. When that belief breaks, productivity doesn't rise. Resentment does. The question isn't whether central banking should exist. The question is whether a system that quietly disconnects effort from reward can remain stable forever. Call to action if this changed how you see money, work, and effort. Share it. Subscribe for deep, calm breakdowns of systems that shape your life without asking permission. Comment below. Do you think the problem is central banking itself or what we've asked it to do? Because understanding the system is the first step to escaping its invisible rules.